Hey, welcome to the 40 Finance channel, everybody. Today we're looking at the Mag 7 stocks, and I'm just going to throw out a crazy idea. It is everything too perfect right now because it's been a heck of a ride since April. Frankly, if you bought in April with the Qs or the TQs or whatever you were up to, it's just been one heck of a run. And if we look at the metrics for the top of the pile, the Mag 7 companies, if you will, things look great, both forward and versus like 5-year averages. So for me, it's just like a spidey sense thing. It's almost too perfect. We know that there are geopolitical type risks out there, but what would it take for things to really turn sour? Are we just going to keep going up? So just for fun today, we're going to look at these Mag 7 stocks and just nitpick at them a little bit. What could go wrong? Where could this win streak end? And it's really just for fun. It's just, like I said, more of a spidey sense for me right now. And as always, we'll be using Seeking Alpha Premium for all of our data points. If you're interested in learning more about this platform, please check out my affiliate link below and help support the channel. All right, I'm going to switch over here to this Mag 7 portfolio I built in Seeking Alpha. And if we look, first of all, at this simple 52-week range, you've got almost everything minus Tesla. You know, Tesla's an outlier in all this with their sort of crazy trading patterns that go on with that one. But for the most part, everybody is above par. Then if you look at the quant ratings, you see this is yellow. These are basically hold signals from the Seeking Alpha quant ratings. And then the analyst ratings, the people right here on Seeking Alpha, you've got a decent chunk of green. Obviously, Tesla's red. And that's more of like a sentiment from writers. And then on the Wall Street side, you know, you got green across the board, again, minus Tesla. Now, for my world, I like to look at where the growth is coming. Top line, bottom line, very, very simple. Mag 7s have feasted off the simple concept of double-digit earnings growth, double-digit revenue growth for umpteen years now. All right, so we just want to make sure that, you know, does that pattern, is there any anticipation that that pattern changes? We got a huge run of earnings coming up here in the next 30 days or so, including NVIDIA today. So, you know, right off the bat, I'm doing this Spidey Sense video, but NVIDIA earnings could come out later and crash the whole thing. Now, what's fascinating to me in this sort of, point in time is all of these companies, they really rely on the revenue EPS growth year over year to continue to make their bull case. Now, on the revenue side, we have revenue growth year over year. All right, so starting with Meta, Google, Amazon, NVIDIA. And then the revenue forward projections. Now, those projections will take shape coming up here. But for right now, what's fascinating is you've got Meta at give or take 19% growth year over year on the rev side, and the forward is projected currently to be right at that number, 19%. Google, 13.13%, so we'll, round down to 13. Next year right now, projected at 13 if you take 12.6 and you round it up. Amazon, 10.8% year over year, we'll call it 11. 10.6 projected for next year. Like, these are three different stocks in, let's just say three different industries who are basically spot on. Then we go to NVIDIA, and it gets a little more interesting. So NVIDIA, obviously explosive growth, 86% year over year to this point. Now, next year, incredible growth at 62% projected, but it is off of the same pace they had the year before. Now, they have managed to do well despite facing a similar challenge here in 2025. 2024, I think they had darn near triple-digit growth, and they rolled into 2025 and they produced 86%, which obviously has been just fine with the market. Tesla was negative on revenue. They are projected, next year. We'll see. I'm not going to spend a lot of time on Tesla. Microsoft, 15%, 14.9, and then next year, 14.7. So round those two up, and they're stacked right at 15. And then Apple, who we know revenue growth is a problem, but we also know that they've had their EPS line always with stock buybacks and an insane efficiency for profits. Apple, 6% revenue year over year, projected at 435 for next year. So, within a percentage point or so, which for Apple isn't too bad. But let's circle back for just 1 second. Meta, positive but flat growth projected. All right. Google, same thing. Positive but flat. Amazon, positive but flat. NVIDIA, taking one step back, but still incredible 62% growth on billions and billions of dollars. It's hard to even fathom how quickly their bank account is growing. Tesla's Tesla. Microsoft, good but flat. No additional, no incremental growth percentage, right? They're not going to go from 15 to 20%, at least as speculated now. Apple, same thing. All right, so that's fine. That's revenue. The majority of the world also cares about earnings as well. And if we look over here, we have EPS year over year, EPS growth forward. All right, so just going very quickly. Meta, 41% this year. EPS growth slows, still awesome, at plus 26. Basically the same thing for Google, 34% this year, could slow to 22% growth next year. Amazon, 56%, down to growing the bottom line at 37%. All right, NVIDIA, very similar to their revenue line, 81% to 67% EPS growth. Again, if you wrote the book, nobody would even believe you on a number like that. Microsoft, essentially flat. And then Apple, where they come up short a lot of times on revenue growth, they could get to 9% EPS growth next year. So when I look at this EPS and then I look at forward PE to trailing 12 months PE, you basically have flat for Meta, give or take flat for Google, Amazon flat. NVIDIA will actually go down a notch from a 58 times to a 41 times if all of this stuff holds true. Tesla flat, Microsoft down a hair if it all holds true, and then Apple down a hair. And my point here on all of this is just like, what a bizarro world. I mean, you're talking about looking in the mirror on some of these growth projections, on a lot of these growth projections for revenue and EPS. How thin is the ice? How much can this waver without seeing these stocks get off of their upward climb? Okay, so just for kicks, I just threw in Google, what are some threats to corporate earnings in 2026? So obviously, I didn't come up with any of this, but I just thought it'd be a lot faster to do it this way. The big thing for me, before we get into these threats, is when you start to have slowing growth percentages. So we went back and saw that everything was a mirror year over year to forward on that last screen. What happens if there's some chops in revenue and then obviously some chops in EPS growth? So projections, if those start to go down, that's when, typically in my world, you start to see the fundamentals change and then the price change. As far as economic and market threats, persistent inflation, that makes sense. That could be a very real possibility, particularly when we don't know what all this interest rate stuff, where that's going to end up and what's that going to do. So that's number 2, interest rates and monetary policy. The thing that's interesting is if interest rates do go down, Most of the Mag 7 companies are very cash heavy, but it does lighten their load a little bit on the loan payments, whatever they're borrowing. There's always a cost for something in a huge corporation, and if you lower interest rates, the cost of carrying that debt, whatever level it is, goes down. So, oddly would add to the bottom line. Additionally, the expiration of some of the 2017 tax cuts at the end of 2025 could dampen consumer spending. So those are some good call outs. And speaking of slower consumer spending, it's expected to remain subdued in the near term. Rising credit card and auto loan delinquencies suggest some consumers may face difficulties, blah, blah, blah. Now, when we think about the Mag 7 and we think about consumer, I put Apple probably at the biggest risk there as far as consumer products. When I think about, Facebook, it's more or less like an advertising game. So consumer spending, same with Google. If that comes down, maybe there's less ad dollars. But outside of like fundamentally how they operate, they don't necessarily need consumers to carry the load, right? There's a lot of ways to make money with advertising and whatnot. All right, and then global threats, rising trade barriers. We all know that. Geopolitical tensions, that hasn't changed in hundreds of years. Supply chain volatility, that's really tied to the geo stuff. And then specific industry challenges, impact on trade-reliant companies. If we think about Mag 7, that's if you got into something with China, that's a big one for Apple. Obviously, NVIDIA is under the microscope all the time on what they're shipping where. Google and Facebook are probably clear. All right, then these next two Mag 7 dependents. While the AI-driven investments of the Mag 7 could boost broader productivity, there is a risk if their spending on stock performance were to falter. A narrowing of the earnings growth gap in 2026, as some analysts suggest, could impact overall market performance. So this is right where I started off on the mirror of growth rates. So we're not seeing incremental growth pace for any of these stocks, right? Google didn't grow 10% last year, and they're projected to grow 15% this year. They're staying flat, like almost all the companies we looked at. With NVIDIA, it's actually going down some. So how much does that make people waver? It's really a buyer question for the stock market floor, to be honest with you. Like, how does that impact your interest in buying? That it is flat but double-digit positive growth. And then the last one, which is probably good, uncertainty around AI. While AI investment is driving growth in some areas, there's uncertainty about the sustained spending on AI infrastructure and how its deployment will impact different business models. That's fair. We don't know where it's all going to end up, but a lot of the big AI jolts to the Mag 7, I think, have been absorbed pretty well. All right, guys, so those are just some things, some metrics that I'm looking at right now. It'll be very interesting to see over these earnings coming up and, of course, into the all-important fourth quarter on the retail side to see if any of the current projections change. My guess is if they change, they will change to the downside. Because things are just so perfect right now. But to be fair, if you look at the chart of the Qs, it's been nothing but up since April. We'll have to see. It is, in my opinion, a very delicate balance right now with the Mag 7. Everything looks awesome, but the margin for error as far as achieving the expectations, I think, will inevitably get harder. Before you go, don't forget to check out that special offer for Seeking Alpha down below. I hope everybody's doing well. We'll see you on the next video.